Types and features of credit. In this chapter, we have several objectives. The first is to understand the different features that go along with credit products. We'll explore them in more detail and look at the pros and cons of the various aspects of credit. We will identify different types of loans and the various types of repayment profiles that these loans have. And finally, we'll conduct an exercise where we analyze a situation and determine what type of loan is most suitable. By the end of this chapter, you should have a very foundational understanding of the different types of credit products that exist, the pros and cons, and features and benefits of those various types. Broadly speaking, there are three main types of credit. One is called revolving credit. It's often a line of credit that has a capped limit, and you can use it up until a certain point when you reach your limit. And there may or may not be minimum payments that go along with it, although there is not a fixed repayment schedule. Then there's an installment loan, which does have a fixed payment schedule. These loans are given for a specific period of time, for example, a 30-year mortgage, a 5-year car loan, a 7-year student loan, or any other type of term loan given to a company. They may be amortizing, meaning there are fixed payments each period, or non-amortizing, meaning all of the principal is repaid at the end. And then finally, there's open credit. With open credit, a company extends to its customer the ability to use its products or services on credit, but that amount is typically due with each month or each period. So for example, a utility bill or cell phone bill. It's billed at the end of the period after which you've been using that product or service. So they are extending a form of credit to their customers. So whether it's a revolving line of credit on the left here, where there is no fixed repayment schedule, or an installment loan that does have a fixed repayment schedule, or an open credit where the amount is due in full each month, you can see that there are a very wide range of credit options and types of credit that are available. Loan payments consist of two parts, principal and interest. Principal is the value of the loan that's being lent out and must be repaid in full. Interest is the additional charge on top of the principal amount that's paid as compensation for making the loan. So, for example, if a loan with a principal value of $4,000 was lent to a customer with a 4-year repayment period, and they were equally amortizing or equal installments along the way, the client would pay $1,000 each year for 4 years until all of the principal balance of the loan was repaid. With interest, we are looking at the fee or the expense that's charged as the cost of making the loan. Interest is what compensates the lender for taking on the risk of lending out the money, and it's calculated as a percentage of the loan principal that's still outstanding. There are two types of interest, regular or cash payment interest, and accrued interest. We'll dive into those in deeper detail in the next lesson. There are two types of interest, regular interest and accrued interest. Let's explore each of these in more detail. With regular interest, it's simply the amount that's due based on the principal of the loan that's actually paid in cash from the borrower to the lender. That can be further broken down into two types of regular interest. There's simple interest, which is where, for example, if you have a $1,000 loan with a 2% interest rate, the interest expense is $20 in every period, regardless of how much time has gone on, assuming the 2% is fixed. And then there's compounding interest. With compounding interest, with the same $1,000 loan at 2%, if there is $100 of interest that has built on top of the principal, then the interest payment increases to $22, which is 2% of $1,100. So this compounding effect means the interest grows and grows over time. Then there is accrued interest. With accrued interest, The same interest calculation is made as regular interest, but it's not actually paid until later. The amount that's owed from the borrower to the lender is not actually paid until later. There are two types of accrued interest. There is simple interest, just as with our previous example, and then once again there's compound interest. So really the difference between simple and accrued is that accrued continues to be owed to the lender over time, whereas regular interest is paid as you go. And both regular and accrued interest can be simple or compounding. Broadly speaking, there are two types of loans. Secured loans that are secured, as the name implies, by specific assets or with specific agreements in place, and unsecured loans that do not have that same level of specific security attached to them. Now, within each of these types, secured and unsecured loans, you then have amortizing loans, where principal repayments are made along the way over the life of the loan, and non-amortizing loans, where principal repayments are not made until the very end. So with both secured and unsecured, you then further break them down into amortizing and non-amortizing loans. Within amortizing and with non-amortizing, you can have both fixed rate loans, where the interest rate is fixed over the period of the loan, or there are variable interest rate loans, where the interest rate moves up and down over time during the life of the loan. So in the coming lessons, we are going to explore all these various types of loans in more detail. Let's take a closer look at secured versus unsecured loans. With secured loans, the borrower uses assets to cover the loan, and those assets are referred to as collateral. That collateral can be used by the lender in the event that the borrower is not able to repay the loan. All else being equal, the security means that there is a lower interest rate that can be charged on these loans. A classic example is a mortgage, where the house is used as collateral against the loan in the event that the borrower cannot repay the mortgage. Now contrast that with an unsecured loan, where it's just the general creditworthiness of the borrower that's used instead of collateral. Since the borrower is deemed to be creditworthy, the lender does not require collateral, but may charge a slightly higher interest rate. For example, a line of credit with an individual is a type of unsecured loan versus that mortgage, which is a secured loan. Let's compare amortizing and non-amortizing loans. With amortizing loans, the principal payments are spread out over the life of the loan. The principal balance decreases over time as principal repayments are made, and is designed to be fully repaid by the maturity date. Principal payments may be the same in an equally amortizing loan, for example, or may vary in an equal payments loan, as we'll show you in the coming lessons. With a non-amortizing loan, the full payment of principal is made at the end of the loan term. Interest payments are still made at predetermined intervals along the way. So why would you take a non-amortizing loan? Well, it reduces the principal amount so the borrower doesn't have to pay as much interest over the life of the loan. If you were to add up the total interest expense for an amortizing loan, it would be less than the total interest expense for a non-amortizing loan. So why would you take a non-amortizing loan then? Well, even though you will pay more interest, the payments that you make along the way will be smaller because you will not be repaying any principal. You will only be paying the interest, so you can conserve cash until the end or maturity of the loan. Let's look at an example of an equal amortizing loan. You'll see in this table that there is a fixed payment of $1,000 of principal, and there's an interest rate of 2%. This loan is equally amortizing in that it consists of 10 equal $1,000 principal payments. The total interest expense varies. It's the highest at the start when the full balance is outstanding, and it's the lowest at the end when the principal is nearly repaid. Now let's look at equal payments. Mortgages are typically structured as equal payments. With equal payments, you always pay the same total payment, but the principal and interest vary over time. As the principal gets reduced, the interest expense goes down, but they always add together to make the same payment. Now let's look at some examples of each type. Non-amortizing loans include credit cards, where you only have a minimum payment and there's no fixed principal repayment schedule. You also have interest-only loans, where all of the principal is paid at the end. An example of amortizing loans is traditional mortgages, where principal and interest are paid every month over the life of the loan, thus reducing or amortizing the principal amount down over time. Let's compare fixed rate and variable rate loans. With fixed rate loans, the interest rate remains the same over the loan term. With variable rate loans, the interest rates are set relative to a reference rate, which changes over time. Let's look at an example of a fixed rate loan. The interest rate does not follow the changing rates in the market, as you can see in the chart on the right. And if you look at the table below, you will see that each year, as the reference rate changes, the interest rate on this fixed interest rate loan remains at exactly 5%. Now let's look at an example of a variable rate loan. You can see in the chart on the top right that the interest rate on the loan follows the reference rate. And you'll notice that the difference between the two lines is the same over time. By looking at the table below, you'll see that the difference between the two lines is called the spread, and that is set in this example at exactly 2%. So when the underlying reference rate is 5%, the interest rate on the loan is 7%. When the underlying reference rate is 5.75%, the interest rate on the loan is 7.75%. So let's look at why you would take out either type of loan. With a fixed rate loan, it protects the borrower from rising interest rates in the future. It makes it easier for the borrower to plan for future payments. However, it's worse for the borrower if interest rates fall in the future. And borrowers also have to consider that there can be significant breakage costs associated with repaying the loan early. With a variable rate loan, there's the ability to capitalize on a reference rate decrease over time. It's worse for the borrower, though, if the reference rate rises over time. Let's look at how we can combine loan features for specific types of lending products. We can take security as the first feature. An example of security would be a loan that's backed by a house as collateral. Another feature might be the fact that it's amortizing. Say, for example, it has 5 years to be repaid in equal installments over those 5 years. And finally, it has a fixed interest rate, say 5%, that's locked in over those 5 years. These three features can be combined in a product such as a loan for machinery or equipment financing. The loan is backed by security, which is the machinery or the equipment. It amortizes over a period of years and has a fixed interest rate. Let's look at another example. This time, an unsecured loan is just backed by general creditworthiness. Non-amortizing, meaning it's just interest that's paid and not principal along the way. And the rate is variable as opposed to fixed. In this case, a company could apply for a line of credit for working capital purposes. You can probably imagine how there are many different combinations of these features that lenders can use to create customized products. Let's look at an example together. Imagine the following scenario. A client is looking to borrow $500,000 to purchase a house. Unfortunately, their credit record is not perfect. They do have some late payments on credit cards. Their salary and income is moderate, and they have a personal belief that interest rates are going to fall in the future. So if we take all of these factors into account, we can come up with the appropriate lending solution for them. The loan should be secured. It's better for the creditor, of course, and since it's going to be used to purchase a house, the house can be used as collateral. It makes sense for this to be an amortizing loan so that the borrower can start to pay down principal as they go along, as they would unlikely be able to repay all of the principal at once at the end. And finally, since they believe interest rates are going to decline, they would likely want to go with a variable rate loan, where the rate will go down over time as interest rates decline. You can see how lenders work with their clients to come up with the appropriate matching of the client's needs and the lender's products. Let's review the common benefits and trade-offs of using credit for both borrowers and lenders. From the borrower's perspective, if you're a company, you can use the credit to gain funds that can be spent to expand or grow the business. Additionally, it may be less expensive than issuing equity to grow or expand the business. For individuals, it can be used for large purchases, such as a home or a car. The trade-offs for both are that you have to pay interest on it. And if you accumulate too much debt, it may be difficult to pay off, and you may end up losing that asset that was used as collateral. For lenders, lending money is a way of collecting revenue streams from interest payments. It's an entire business model for lenders. The risk for lenders and the trade-off, though, is that if default rates rise, they may have loan losses that they can't sustain, and they could go out of business. So depending on the situation, for the borrower and the lender, credit can be a great solution for both parties, but it certainly has its risks on both sides as well.